Hello everybody, Courtney Henson here. Today I'm going to be discussing my findings for Project 2. I'm going to start by kind of telling you about my approach to the project. We'll talk about the company that I chose, why I chose it, and we're going to go into some of the stats for the company, the financial figures, liquidity ratios, profitability, stock prices compared to the market, compared to its competitors. So let's kind of talk about the approach a little bit, about why I just kind of operated the way that I did. So the first thing I did was immediately eliminate companies that I knew I could not see myself investing in. It was a lot of data. There was a lot of numbers in that spreadsheet, and I felt like I just immediately needed to kind of eliminate the ones that were red flags for me. And there were 5 right off the bat that I knew I just could not invest in. Let's start with Entergy. I eliminated them mostly because their equity multiplier was really high at 4.62. To me, I felt like they were relying on too much debt in the short term to pay for their assets. And I felt like the number was kind of alarming, especially compared to its competitor, Clico. They had an equity multiplier of half that. I also eliminated Hancock Bank due to their low ROE and very high equity multiplier. The ROE isn't low for the industry. In fact, it's pretty on point for the financial service industry. It was just too low for my personal investing strategy. The equity multiplier, now that's a different story. It was the highest of all the companies at 8.14. I just could not invest in a company that was relying so heavily on debt. I also eliminated Global Star and Amedisys for their negative ROE and terrible operating margins. They did both have a price to book ratio below 1, which could indicate that the stock could tick back up eventually, but I just did not think that would be the case with Amedisys, especially considering the state of healthcare and home health due to Obamacare. A lot of that's going to be going into effect in 2014, and it's really going to impact the company quite negatively. I did not know a whole lot about Global Star. I just knew that based on the numbers, I did not want to proceed further with that company, and the same can be said for Lamar. They had a few negative numbers as well, and I just eliminated them right off the bat. So after that, I evaluated the rest of the companies to determine which ones really stood out. And for me, these 4 companies really stood out above the rest, and for pretty much for all different reasons. But let's start with Clico and kind of see why I liked it. They had an ROE that was really good for the industry. They had an operating margin that was really good. Their stock price was affordable and the dividend was decent. They had a good ROA for the industry, and they have a low beta, which is not risky to add to my portfolio. And that makes sense since this is an energy company. Their sales aren't tied to the economy as much because it's energy. Everybody needs it regardless of if we're in a recession or not. Also, CF Industries really stood out to me. I felt like they had great ROE numbers, they had great operating margins, and they had good liquidity ratios. 3M was a good company across the board. They had solid numbers this year, last year, the year before. Their ROE was good, their liquidity was good, their PE ratio was really good. They just seemed solid. And Poolcorp, this one kind of surprised me a little bit. I really liked their numbers. I thought that they, again, had a high ROE. That was one of the things that I was looking at the most. They had lower operating margins. They had good liquidity ratios, and their PE was great as well. And again, they had low risk. Adding them to the portfolio would not be quite so risky. So kind of after briefly looking into each company and evaluating the numbers, it was time for me to make my decision. And the company that I chose is CF Industries. And ultimately, I chose them because I was impressed by their overall numbers, and I felt like they had the most upside and potential to invest in moving forward. So a little bit about the company. CF Industries, they manufacture and distribute agricultural fertilizers such as nitrogen and phosphate worldwide. They were established in 1946, and they operate out of Deerfield, Illinois. They also have a plant located in Donaldsonville, Louisiana, which is why they showed up on our list. So they operate in two separate segments, nitrogen and phosphate, and then amongst those they have subgroups of names that I can't pronounce. I'm sure engineer or science major could tell me otherwise, but they also own a company, 50% of a company in the UK called Growhow, and that company also does the same thing, agricultural fertilizers. Their customers are mostly cooperatives and independent fertilizer distributors. So let's look at some of the numbers that affected my decision, and we'll start with the stock prices. As you can see here, there's some ups and downs, which is to be expected, but there's been a steady increase in the stock price over the years. This is over a 5-year span of time, but here's quite alarming. From 2008 to 2009, there's a significant drop, but I think that's when most companies had a significant drop. You know, they all look like this. But again, there's a steady uptick, and I really liked the look of that. I also compared their stock prices to competitors and to the market. Here, they're the blue line at the top. Compared to their competitors, they are performing really well. And then compared to the market, I found this very interesting. This is them here, and this is the market. As you can see here, down here, this is between 2010 and 2011, and then they have a very steady uptick, and they start performing pretty much exactly like the market. I thought this was interesting, and it really made me want to take a look at their volatility. I wanted to see what their numbers look like. I want to see how do they perform in comparison to the market, because when the market's down, they're really down right here. But when the market's up, here they really kind of started tightening up. So I thought that was really interesting there to look at. The estimated stock prices, I went ahead and forecasted out for 2013 and 2014, and just took the prior PEs and kind of backed out of that. But the estimated stock price for 2013 is $182.47, and for 2014 it's $176.97. Currently, their stock is trading at $171.50. So both of these numbers are pretty much right in the range of what it's in right now. I felt like it's pretty positive over the next couple of years that it's going to maintain some value there. So after this, I started looking at the financial information. I wanted to see how much do they make, how much of it are they operating with, what's their profit on what they're making. Their revenue for last year was $5.91 billion, and their gross profit was $3.11 billion. They have total debt of $1.6 billion and total cash of $2.21 billion. I really liked kind of the disbursement here between debt and cash. I thought that was a good difference there. But these numbers here were the ones that really stood out to me the most: profit margin and operating margin. They have a profit margin of 31.91% and an operating margin of 47.71%. These are really great. They have one competitor who had an operating margin of 13% and another who had one of 23.51%. So that's really, really positive compared to its competitors. With the operating margin like that, it shows that they are making about 48 cents per dollar of sales. That's very efficient. They're being efficient with their money. So after this, I looked at their liquidity ratios. Cash, quick, and current ratios were all in the 2 range, from 2.3 to 2.9. I felt like those numbers were pretty positive. They aren't over leveraging themselves in the short term, so I really liked the look of that. Some other key stats that I kind of looked at were the PE ratio, the PB ratio, the ROE, and the ROA. Their PE ratio was at 6.25%. So this is somewhat low, and especially compared to its competitors, it's low. It kind of alarmed me at first, but when I really got into it, I wasn't quite so worried about it. Their competitors had a PE ratio around 11, so at 6.25 it did seem kind of low. At first, it could either indicate that the stock is undervalued or their earnings are in decline and the company's not doing so hot. But their earnings aren't in decline. Their revenue has increased tremendously over the past 3 years. In 2010, it was $3.9 billion, and since then it's maintained around $6 billion. So it's pretty much constantly going up. So I feel like the company's not doing poorly. I think that perhaps the stock is undervalued. And also, if you look at the PB ratio of 1.81, to me that also kind of reinforces that the stock could be undervalued. The ROA at 18.14 is very high for the industry. Their competitors were 12.07 and 11.89 respectively. And the same can be said for their ROE. They have an ROE of 35.38. Their competitors were 23.41 and 16.34. So that's a big difference between 23 and 35. These numbers are really high, and just like the operating margin, the ROE is showing that the company is efficiently utilizing its assets to generate earnings. So after seeing this really high ROE number, I decided to take a look at the DuPont analysis to figure out what's driving it up like this. And the first thing that I noticed was the profit margin. The profit margin is really high, and that is the main thing that's driving up their ROE. This is a really positive thing to me. It shows that their company is not relying heavily on debt to increase that return on equity. Now, the equity multiplier is also a contributing factor here, but not nearly as much as the profit margin. To me, that was the biggest percentage there. I did notice that they had a relatively low total asset turnover, and it has been decreasing since 2007. But compared to its competitors, it's pretty average. So after looking at this and feeling pretty good about the ROE, I started looking at the relative volatility of the company and the beta. This screenshot here is pulled off of Bloomberg, and as you can see, the beta currently is at 1.27. That's kind of surprising to me. It's not quite as risky as I would have thought it was. It's a fairly unrisky stock to add to your portfolio. Now the relative volatility, once I calculated that, was quite high at 2.26. That means the stock is twice as risky as the market. And for me, I don't mind that as much. I actually kind of prefer it. I feel like from an investing strategy for someone at my age, that's a really good place to be. I can take on a little bit more risk and feel okay about it. And I think that in the long run, the stock is going to perform really well. So after feeling good about that, I move on to their economic value added and their weighted average cost of capital. As you can see here, I really like the weight of their debt and their equity. They had 87.8% was equity, and the debt was 12.2%. Though that was a really great kind of balance there. Over here in the bottom right corner, the economic value added was really positive as well. This number here, the net operating profit after taxes, was almost $2 billion, $1.9 billion, and their total investment capital, or their capital from their shareholders, is a little over $9 million. So that gives them an economic value added total of $1 billion. This number really captures the company's true economic profit, and as you can see, the number's really positive, so I felt really good about that as well. So kind of wrapping it all up, some of the trends that I saw with the company and some of the things that I really liked about it. I felt like the numbers were consistently good over the last couple years. They had a few rough years, 2008 to 2009, but there's been a constant uptick in their numbers since then, quite dramatic actually, since 2010. So I was kind of wondering what happened then, what caused the company to kind of start really hitting great numbers like that. And I discovered that that's when they acquired Terra Industries. And this proved to be a really good move on their part. It positioned them to be a major player kind of in the global game. And I feel like, leadership's doing a great job in that case. And that's the second point I wanted to make about management and leadership. They're doing a great job. I feel like the company is in really good hands. They're making good decisions. That's evident by their operating margins. It's evident by their ROA and their ROE. And the last point I wanted to make was the stock possibly being undervalued. I wanted to kind of bring that to the surface, I guess, and that's a really positive thing if that's the case. But ultimately, with the stock being quite risky, I would definitely want to invest in it as part of a diversified portfolio, like Dr. Cresson said, perhaps even as a portfolio with the other 3 companies that I was considering. They're a little less risky and would be a really great balance there. So that's my company, CF Industries, and thank you for your time.